Welcome back to our channel. Now we are discussing on a very important topic, how a foreign company can set up a business in India. Setting up business involves a structured process under Companies Act 2013, FEMA, Foreign Exchange Management Act 1999, and mandated by Reserve Bank of India, RBI. We'll go by step. First, choosing the right business structure. So the very first step for any foreign company is to decide what kind of entity they want to establish in India. This decision depends on your business goals, the level of control, and nature of your operations. For this, there are key options available. First, we'll see WOS, wholly owned subsidiary, or JV, joint venture. The private limited company is the most preferred route. A WOS, wholly owned subsidiary, is where the foreign parent company owns 100% shares. A JV involves joint venture, partnering with an Indian company, sharing ownership. This structure offers limited liability protection, separate legal entity status, and maximum operational flexibility. Under foreign direct investment, FDI, automatic route, most sectors allow 100% foreign ownership. And second option is the Liaison Office, LO, acts only as a communication channel between the parent company and Indian parties, cannot undertake commercial activities or earn income. Expenses must be met through funds remitted from abroad. It requires RBI approval. This is licensing office, LO facility. Other one is a branch office, BO. Can carry out specific activities like export, import of goods, consultancy, or professional services. This is BO, branch office. So it can be carried out like export, import of goods, consultancy, professional services. Not allowed to engage in retail trading or manufacturing. It needs RBI approval before setup. Then another option is PO, project office, set up for execution of a specific project in India. It's a temporary in nature and linked to particular contract. It requires RBI now. For companies planning long-term operations, a private company, that is subsidiary JV, is the most recommended option. Subsidiary or joint venture. Because of companies for long-term operations, either subsidiary or joint venture is the most recommended option. Another one is obtain essential identifiers. Before filing for incorporation, the directors and shareholders need to complete certain formalities like digital signature, DSC. This is a mandatory for signing of MCA filings. So foreign nationals must get their documents notarized and apostilled in their home country. And then DIN number, director identification number. This is a unique number issued by MCA to directors. Can be applied along with the company incorporation through SPICE plus form or separately also. Then company name reservation. Apply for company name reservation through run service and MCA portal. Ensure the proposed name is unique and identical to, this should not be identical to existing companies, or it should be a unique name. So ensure the proposed name shall be unique and not identical to existing companies or existing trademarks. Keep few backup options also, suppose if any rejection. And then incorporation through SPICE plus form. So the SPICE plus form is a single integrated application on the MCA portal. So what are all documents required? MOA, proof of registered office address, director declarations. MOA is memorandum of association. It defines company objects. MOA is articles of association, sets internal rules, proof of registered office address, and director's declarations. These are the documents required. Now integrated registrations through SPICE plus. Once the company incorporates, then you will get a certificate of incorporation, PAN number, permanent account number, and TAN, tax deduction and correction number, EPFO and ESIC registrations, professional tax wherever applicable, bank account opening. So once approved, the ROC issues certificate of incorporation, making the company a legal entity. FDI, foreign direct investment and RBI compliance. So after incorporation, the next step is to comply with the FEMA RBI guidelines. FDI route, foreign direct investment route, automatic route, no prior approval is needed. Investment can be made directly in permitted sectors. If it is a government route, prior approval is mandatory for restricted sectors like defense, telecom, and multi-brand retail, etc. And FEMA reporting requirements within 30 days of inward remittance, report to AD Category 1 bank, and within 30 days of allotment, file FCBPR on RBI forms portal. Because non-compliance may attract penalties under FEMA. Then ongoing Companies Act compliance will be there. At least one director must be a resident of India, maintain proper books of accounts, and annual filings. There is annual return and financial statement with ROC. Conduct statutory audit every year. And it has to be displayed the company name with the SIN number, registered office address, and letterheads, email IDs, and websites. And then taxation and other registrations. Corporate tax rates for foreign companies vary typically 22 to 40%, depending on the nature, structure. GST registration is mandatory if turnover exceeds threshold or if engaging in interstate supply. Transfer pricing regulations apply for cross-border transactions with parent company. Post setup, the best practices is a shareholder agreement in case of JV, strong compliance management to avoid FEMA penalties. DTAA, double taxation avoidance agreement benefits between India and your country. It has to be considered. And keep track of sector-specific laws like SEBI, IRDA, or RBI, depending on the industry. Because there are penalties for non-compliance. These are Companies Act violations. Penalties range from fines to disqualification of directors. FEMA violations can attract the penalty up to 3 times of the amount involved, or 2 lakh plus daily penalty. Non-reporting of FDI can block future remittance. So the conclusion for setting up, first step is decide the right structure, whether only one subsidiary, JV, or licensing office, or branch office, or project of PO, and obtain DSC and DIN. Third step is reserve the company name. Fourth step, then you can go for incorporation through SPICE Plus. And fifth, report FDI to RBI, foreign direct investment to RBI, and comply with FEMA. And next step, fulfill annual compliance under Companies Act 2030 and take care of taxation and GST obligations. Follow the best practices to stay compliant. We have 2 channels, RR Corporates and other channel RR Legal Talks. Please do subscribe and hit the bell icon so that you will not miss any of our latest videos. Thank you.